I'm going to show you 18 ways to pay less tax and maximize refunds on your 2024/25 Australian tax return. These include overlooked tax deductions, and some you can claim without receipts, even if the total claims exceed the $300 limit. I will also include the tax codes so you know exactly where to claim to boost your refund or reduce your tax. If you're new here, I'm Veronica, a board-certified tax accountant in Australia. Just a disclaimer, this video is general guidance only, so please consult your tax agent or accountant or financial advisor for advice specific to your situation. Now, I want you to claim with confidence, and that starts with understanding how tax deductions work in Australia. The amount that ATO tax you on is called taxable income. To get taxable income, assessable income is reduced by allowable deductions. Assessable income means money you earn from work or investments, and allowable deductions are expenses you incurred to earn that income. You see, on the taxable income amount alone, ATO imposes federal income tax, Medicare levy surcharge if you don't have adequate private health insurance, Division 293 tax, tax help, or student loan repayment obligations. So deductions helped reduce your taxable income, which results in lower tax liabilities or increases tax refund. Now, to claim a tax deduction, you must meet the ATO's 3 golden rules. 1, you spent the money yourself and weren't reimbursed. 2, the expense must directly relate to earning your income. 3, you must have a record to prove it, usually receipts. Don't stress. I'll point out which tax deductions you can claim without receipt as we go. Also, for every claim, remember to declare any allowances received as income, apportion or pro rata any expenses partly for work. If partly reimbursed, claim only the net amount. So don't claim expenses if you're fully reimbursed, and don't claim the same deduction under multiple tax codes. If your total deductions exceeds $300 per return, you'll need evidence. If it's $300 or less, you don't need receipts, but if the ATO asks, you need to be able to prove that you paid the claim. Here's the good news. This $300 limit doesn't apply to D1, work-related car expenses if you're claiming under the cents per kilometre method, D2, travel expenses, D5, meal allowances, and D2 for award transport, payment allowances. Now, each deduction below is labelled D1 to D15 in your tax deduction schedule, regardless of whether you're using myGOV, paper form, or other tax software. I've also included the ATO's quick codes, so you can easily search them on the ATO's website search bar for more detailed information and examples. First, let's cover depreciation expenses, as you may claim it under D1 to D5, depending on what the asset is used for. So if you use assets like a car, briefcase, laptop, desk, or phone for work, you can claim tax depreciation deductions for their wear and tear. If the item is $300 or less, you can claim the full amount, but just remember to apportion it if it's partly used for work. If it's over $300, you must depreciate it over its effective life using either the diminishing value method or the prime cost method. The formula is here, it's very easy to follow. To find the asset's effective life, the link is in the description box below. And remember to apportion or pro rata if it's partly used for work, okay? Here's an example. You bought an iPhone 16 on 1st of January 2025 for 1.8K and used it 50% for work. With an ATO's effective life of 3 years and using the diminishing value method, you can claim $297 under D5. Here's a tip. Only use the diminishing method if you want faster write-off or depreciation in early years. Use the prime cost method if you prefer even, predictable deductions each year. Here's the 18 deductions that you're waiting for. Please note D1 to D5 relates to your work as an employee. So D1, work-related car expenses. To claim car expenses, the ATO has 5 conditions you need to meet, like meeting the car definition, owning or leasing it, using it for work-related trips, not from home to work, and vice versa. But there are exceptions for these taxpayers here. I won't go through them all, so feel free to check the details later. And if you meet these 5 conditions, there are 2 methods you can use to claim. The logbook method, which requires you to keep a logbook for 12 consecutive weeks, So you can work out your work use percentage. This percentage is then applied to actual car costs like depreciation, fuel, oil, insurance, maintenance, repairs, registration, etc. You need to create a logbook once every 5 years and keep all receipts and records. Now, the logbook method is ideal if your car is relatively new, like under 8 years old, or under finance, and if you use it a lot for work. If the logbook method scares you, the cents per kilometer method is much simpler. In the 2024-25 financial year, you can claim a maximum of 5,000 kilometers at 88 cents per kilometer per car per year. All you need to keep is the date, destination, distance, and purpose. This method covers all car expenses, so you cannot claim fuel, oil, interest expense, etc. separately. And that's it. No receipts, no logbook needed. Here's a tip, and I'll send you a bill later. Say if your car is over 8 years old, not under finance, you worked 48 weeks in a financial year, and you spent less than $91 per week. Go with the cents per kilometer method and keep those records. D2, work-related travel expenses. If you're required to travel overnight for work, like flying interstate or overseas, you may claim expenses like accommodation, meals, incidentals, and transport expenses. And if you've traveled overnight for 6 nights or more in a row, you need to keep a diary. The example, QC 72131. But if under 6 nights, no travel diary is required. If you've traveled for the day and returned home, you can only claim transport cost. So meals and accommodations are not tax deductible. You need receipts for both overnight and for the day travel expenses. Now, you may not need to keep receipts for travel allowance expenses claims within the reasonable amounts, depending on the type of travel. So check your eligibility at QC 72135. D3, clothing, uniform, and laundry expenses. Let's start with the clothing that you cannot claim first. So you cannot claim a deduction for buying, hiring, repairing, cleaning, washing, or drying conventional clothing like black trousers, white shirts, and business attire, even if you wear it for work. However, you can claim a deduction for the following 4 clothing. 1. Compulsory uniform means it must be distinctive to your organization or identify the products or services provided by your employer, like a police uniform. 2. Non-compulsory uniform means uniform that has your employer's logo on it. Your employer has registered the design of approved occupational clothing, and you must wear the uniform to work to claim a deduction. 3. Protective clothing. To claim a deduction, your protective clothing must meet 2 criteria. 1. It has protective features or functions, and a sufficient degree of protection against the risk of illness and injury you're exposed to in carrying out your work. These include fire-resistant clothing, sun protection gear, and safety-colored vest, etc. Category 4 clothing. Occupation-specific clothing means clothing that distinctly identifies you as a person associated with a particular occupation, like a chef's checkered pants or a judge robe. So if your clothing falls under the aforementioned categories, you can claim the actual cost you incur to dry clean and repair, and the cost to wash, laundry or launder, dry, and iron it, including laundromat expenses. The A2 allows $1 per load if the entire load is work-related clothing, and 50 cents per load if the load is mixed with private clothing. And please remember to keep receipts if laundry expense alone exceed $150. D4, self-education expenses. So D4 covers education costs relating to your current job and not a new one, okay? You can claim a deduction if the course maintains or improves skills or knowledge for your current job, or could lead to an increase in income in your existing role. Claimable expenses include course or tuition fees, textbooks, stationery, internet usage, depreciation on work-related items such as a desk, a chair, and printer, etc. D5, other work-related expenses. One common D5 claim is home office expenses. So if you work from home, you may claim using one of the 2 methods. The fixed method at 67 cents per hour. This covers electricity, heating, cooling, phone, internet, stationery, stationery, and consumables like ink and paper. You can also claim depreciation for tools and equipment separately. Just keep a diary, a timesheet or a roster, along with receipts for depreciable items. The actual cost method. If you've got a dedicated work area like a separate room, work out its size in square meters, divide it by your home's total internal area to get your work use percentage. Multiply that percentage by eligible costs like electricity and cleaning. You can also claim phone, internet, stationery, etc. and depreciation items like your desk or chair separately. Just keep records for all calculations and receipts for depreciable items. Another item, the D5, is phone and data usage. To claim phone and data deductions, either keep a 4-week work use log or 1 monthly bill. Add up all your work-related calls and divide that by your total calls for the month. Apply that percentage to your total paid phone bills for the financial year, and that gives you your claimable amount. Here's another common D5 item: overtime meals. So you can claim a deduction for overtime meals if you meet all of these 3 conditions. You buy and eat the meal while working overtime, you receive an overtime meal allowance under industrial award or enterprise agreement. The allowance is shown on your income statement and you declare that as income on your tax return. You will also need written evidence like receipt if it's above the prescribed reasonable amount. And full details and example can be found at TD 2024/3, and the link is in the description box below. Now, you do not need to keep receipts if you met all 3 mentioned conditions. Plus, you spent less than the reasonable prescribed amount. And other common D5 deductions are license and certifications, like security license if you're a security guard. We're not talking about driver's license or special machinery licenses here, okay? Professional association and union fees, so accounting, medical and construction workers will have these. Reference books, journals and trade magazines, and work-related applications or software such as Microsoft Suite, Xero, etc. D7. Interest expense on financial instruments. If you borrow money to earn interest, you can claim related costs or management fees on that loan to minimize taxes. D8. Interest expense on dividend income, also known as interest expense on margin loan. So if you've got a loan for investing in dividend shares, you can usually claim the interest as a tax deduction. And if it's a fixed margin loan, you might be able to prepay 12 months of the interest and bring that deduction into this financial year. So check with your lender or advisor. D9. Gift or donation deduction. You can claim a deduction under D9 if you donated $2 or more, you've got a receipt, you donated to a deductible gift recipient. DGR means Registered Australian Charity Organisation. So not your GoFundMe or Wikipedia donations, okay? And no deduction if the organization cannot be found via ACNC and the ABR website, or you receive dinners, raffle tickets, etc. in return. D10. So D10 allows a deduction for the costs related to managing your tax affairs, like fees paid to your registered tax agent or travel costs to meet your tax agent or tax accountant regarding income and tax deductions advice, and legal or litigation costs regarding tax matters. D12. Make personal concessional super contribution. If you're under age 75 and meet the work test, if you're aged 67 to 74, you can make personal concessional contributions to super and claim a deduction under D12. So to do this, you make concessional contributions, submit a notice of intent to claim a deduction to your super fund, and receive an acknowledgement from your super fund confirming your contributions and notice. Now, the 2024/25 financial year concessional cap is $30,000, which includes your employer contribution and any salary sacrifice. But if you've reached your 2024/25 $30,000 cap, here's good news. You can carry forward any unused caps from the past 5 years rule. So to qualify for the 5 years rule, if your super balance was under $500,000 as of 30th of June prior year, so we're in June 2025 now, so that's 30th of June 2024. This rule commences on the 1st of July 2018, and the oldest unused caps gets used first, and each one expires after 5 years. So to check your unused caps, go to myGOV, click on the ATO, click on Super, and then click on Concessional Contributions. See how much you and your employer have contributed each year, then subtract the annual cap amount from the contributed amount. Add up all of the unused amounts for the past 5 years. Let's bring it to life with a quick example. Let's say Sarah, aged 55, who didn't work for the entire 2024/25 financial year. Hence, there's no contributions from an employer. And her super balance is under 500K as at 30th of June 2024. She sold a rental property in March 2025 and makes a 213K net capital gain. And to reduce her capital gains tax, Sarah makes a personal contribution of 83K, using the 30K from the 24/25 cap and 53K in unused caps. She submitted a notice of intent to claim a deduction to her Superfund Host Plus on 1st of June 2025 and receives an acknowledgement notice from Host Plus on the 12th of June 2025. She claims an 83K tax deduction in item D12 in her personal return deduction schedule. D15, other deductions. Now, a common deduction under D15 is income protection insurance, which allows you to claim a deduction for the premiums you pay for insurance against the loss of your employment income. And last but not least, I've got a bonus tip for first home buyers, which is the First Home Saver Super Scheme, FHSS. Now, this scheme lets you save for your first home deposit through Super with tax perks. So you can make voluntary contributions, either concessional or non-concessional, meaning before tax or after tax. This scheme is ideal if you're a first home buyer on a moderate to high income wanting to save faster for a home via Super. So to qualify, you gotta be 18 or over, never own property or real estate in Australia. You plan to live in the home for at least 6 months, and it can't be for an investment property. Under this scheme, you can save 15K a year with a 50K total cap per person. So if you make concessional contributions like D12 personal contribution, you can claim a tax deduction, but only 85% gets released back to you because of the 15% super tax. Non-concessional contributions gets 100% released, and when you're ready to withdraw, request an FHSS determination and sign a contract to buy within 12 months. And please remember, the D12 annual concessional cap still applies. Now that we know allowable deductions reduce taxes, but if you want to save your taxes even more, check out my video on 11 ways to earn tax-free income on investments in Australia. It will show you how to earn tax-free income, use capital losses effectively, apply smart strategies like capital gains tax concession, negative gearing, debt recycling, and many more. I didn't cover D6, D11, D13, and D14 as they are less common, but if you are curious, feel free to check them out in the ATO website search bar. And that's how you legally avoid taxes in Australia, guys. If you find this video useful, please hit like and subscribe. It really helps the channel. Leave a comment below if you've got any questions. I will try my best to reply. Good luck with your 2024/25 financial year tax return. Fingers crossed you'll get a big refund. In the next video, I'll be sharing 6 capital gains tax exemptions that you can claim when selling investment or rental properties in Australia. So ciao for now.